Kia ora and Bulla, and welcome to our discussion today on inflation, changes in values and their respective impacts upon your claims and upon your insurance and risk management programs. It seems, I think, for many of us today that inflation is here to stay, and certainly in many corners of the world seemingly running rampant, and therefore, at Marsh McLennan here, this is certainly something that we want our clients and our portfolio to anticipate and start to prepare for. My name is Josh Roach, and I'm the country head for Marsh in New Zealand, and I'm also the chairman of Marsh in Fiji. And I'm dialing in today from Auckland, and thanks to everybody who's joined us this morning. Before we get started, I'd just like to pass the floor to my colleague Sarah Rowe, who's going to lead us off with a mihi.
Kia ora te whānau. He aha te mea nui o te au, he tangata, he tangata, he tangata. E mihi ana I te mātua nui I te rangi, nāna nei, nā mea katoa. E nā mana whenua o tēnei rohi e mihi ana, kia koutou katoa. E te whori e tūnei, tēnā koe, te hanga mate ki te hanga mate, te hanga ora ki te hanga ora. E te rangatira ko Josh, tēnā koe, e nā marawhiri, e nā kirataki, me nā hoa mahi mai e Aotearoa e whiti, tēnā koutou katoa. Kua tai mai mātou, ki te huihui nā te mea ka hia mātou, ki te whakarongo me te ako. Nō reira, ko te mātou whāinga. Mō te au, ki te whakaririki, e tāua wā tonu, ahakoa hei aha. Ko te whakamarama mō tēnei. Ki te noho, ki te taha o a mātou kirataki, ka hia ana I a mātou. Ki te āki, ki te whakatika, ki te tohu. Ka te atu mātou, ka hia anā koe, I a mātou. Tēnā koutou, tēnā koutou, tēnā koutou katoa. Welcome, everyone. What is the most important thing in the world? It is people, it is people, it is people. I acknowledge the gods to whom all things belong. To the people of this land, I pay tribute. And to this house standing here, I greet you. We acknowledge those that have passed and their connection to those that are here, and acknowledge those that are here and their connection to those who have passed. Welcome to our country head for Marsh, Josh, and to our guests, clients and colleagues from across New Zealand and Fiji. We have joined here today to listen and learn. We're here to make a difference in the moments that matter, which means being there when you need us most, dealing with challenges, creating solutions and providing advice. We'll be here when you need us. Welcome.
Thanks, Sarah. Really appreciate it. And it's really great to see so many clients and familiar names joining us from New Zealand and also Fiji. And I'm really looking forward to an engaging and interactive conversation with each of you over the next hour or so. So, I think it's fair to say we are seeing a huge surge in inflation locally as well as globally. And sort of unfortunately, this is also being compounded by many of the global themes that we're experiencing at the moment, such as Russia's invasion of Ukraine, the sort of slow emergence from the pandemic. And then at the local level, spikes in commodity prices, increased labor costs, I think is being felt by many of us, including disruptions within the supply chains, and certainly with many of the conversations that I'm having with our clients here in New Zealand and also in Fiji a couple of weeks ago. These topics are very familiar and certainly top of mind, for many boards around both of those countries. At the local level as well, inflation is just hovering above 7% in New Zealand and just above 5% in Fiji. And none of us are immune to inflation. Every industry at the moment is impacted. Certainly at Marsh McLennan, we're not immune to inflation either. And so I think really just to get the conversation started this morning, I thought it would be really helpful if we just started with a quick poll And we ask everybody on the call this morning if you could just jump in and nominate what the cost of doing business has been for you over the last 12 months or so, and then we'll take a read on that and come back to you. So this is a single choice answer. So if you can jump in, and we'll show you the results when they're finished. So we're going to close the poll now, and let's have a look at the results. Okay, interesting. So 51% have said that the cost of doing business has gone up between 5 to 8%, which is really interesting. I would have felt maybe it was closer to 9 to 12%. So interesting to see people there, hovering around 5 to 8. So look, this is a really interesting data point. And in this session today, we're going to share examples of how inflation can impact different assets depending on how they're treated, and therefore there's not really a blanket approach or one size fits all approach to how you assess the inflationary impacts upon your assets. Okay, so let's move on. Your business interruption and asset values do become really, really important, especially with respect to declared values and how that's being evaluated. Obviously, inflation, as we know, can drive up values significantly. And in many cases, this could cause overinsurance or indeed sometimes underinsurance as well. And I think it's quite sort of awakening if you pause now and you just think about the business in which you're operating. And if you were to suffer a significant loss right now, how would you respond, and how would your business be able to respond in that sort of situation? And so, that's really the purpose of the webinar today. And really, as your risk advisor, it's really just about making sure that you're fully aware of the risks of inflation and their impacts upon your claims and upon your risk management programs. So let me introduce the panel today. So joining me today is Simon O'Brien, and Simon leads our valuation division, and he specialises in insurance valuations, and Simon's undertaken the valuation of over $100 billion of assets annually. Pat Hunter, so Pat leads Marsh's advisory business across both New Zealand and Fiji. And within advisory, Pat specialises in claims and business interruption. We next have Catherine Osborne, and Catherine has 30 years experience in insurance and reinsurance law and commercial litigation. Catherine brings together all aspects of Marsh Pacific's claims experience in the delivery of claims services and being side by side with our clients in claims matters. Justin Armagnac has 18 years with Marsh, and Justin specialises in the placement of major property programs. Justin leads the Marsh placement team for us here in New Zealand and leverages our local and global relationships to deliver efficient and effective risk transfer solutions. And then we have Tim Ashton, and Tim leads Marsh's valuation division in New Zealand, providing specific expertise in valuation matters relevant to the local market. Currently undertakes work for a range of major New Zealand clients across various sectors. So thanks, team, and really appreciate you joining me this morning. And really quickly, just before I hand over to Simon and Pat, let's take another quick poll. So if we could please bring that up onto the screen. And if you could just dive in and let us know, when was the last time you validated your declared values for assets and business interruption? Okay, we'll close the poll there and let's see what the poll is telling us. Oh, interesting. Okay, so more than half of respondents have said that within the last 12 months, you've undertaken a valuation of your assets, which is good news. So again, thanks for joining us today. If you do have any questions, we will save some time for Q&A at the end. Please jump in and use the functionality within Zoom. And on that note, I'm going to pass the floor over to Simon and Pat. Over to you.
Yeah, thanks, Josh, and thanks everyone for dialing in today. As Josh mentioned, I'll talk about the impact on inflation and asset values for insurance purposes. So for your material damage policy and what we're seeing from within the market there. So if we just go to the next slide there, I'll start with the basics essentially, and I'm not going to go into technical policy wordings or anything like that and keep it fairly simple today. But the obvious objective for setting declared values and accurate declared values for your tangible assets is so that your insurance policy responds adequately in the event of a loss. So basically that the cover that you're buying is suitable for the assets that you're insuring. The most common basis of value within an insurance policy is what's called a reinstatement cost. So to put that very simply again, that's the cost to rebuild or reinstate or procure an asset and put it back as new. So the same asset, but brand new, same materials, same configuration, but again, brand new. We're not taking into account the market value, the depreciation, or any elements like that. We're looking at if you had to rebuild or purchase and install that asset again tomorrow, what would the cost of that be? So an insurance, in determining that, an insurance valuation is the most accepted way from insurers in terms of how you come about your declared values. Now, obviously, the intention of this is minimizing the potential for under or over insurance. So we're wanting to make sure that, again, if there is a loss, that you're not finding yourself with inadequate cover, and conversely, you're not over insuring and paying too much premium on that. Whilst that's the key driver, valuations also have the added benefit of providing comfort to the market that you've had your values professionally determined. Whilst you might have a good handle on your assets and how much you've just built something for, again, the valuation is showing goodwill to the insurance market and showing that you're going about determining those tangible asset values, utilizing a professional and undertaking those. It also makes sure it's tailored to your insurance policy as well. Through doing this, you're negating insurers potentially looking to impose clauses on your policy that could penalize you in the event of a claim, such as a margin or underinsurance clause. It helps your broking team potentially ensure that these don't form part of your policies. I'll talk about this briefly later and go into a little bit more detail around what this means. And finally, the valuation also typically include an indemnity value for fire and emergency levy calculations. So the levy that's payable is determined on an indemnity value, which is different to a reinstatement value. So if you're determining your FENZ levy calculations at the moment based on your reinstatement value, I'd suggest you speak to one of the team about how you can go about getting an indemnity value to determine those values in the future. So in the valuation world, it's not just buildings. And we often have this conversation where the property or the building side is the asset that gets looked at the most. It's obviously what we're all sitting in now. It's a large asset with 4 walls and a roof. And in a lot of situations, it makes up the majority of the value of your declared values. However, this often means as well that we see clients not giving due consideration to other assets. So there's 3 types of value, essentially. So there's the buildings value that we just spoke about. There's also plant, equipment, infrastructure, and contents values. So that's looking at assets that aren't a building, whether it's a piece of machinery, whether it's tables and chairs, or whether it's fit out to leased premises. Often we see that sometimes this isn't given the due consideration that it should be and needs to be looked at in a little bit more detail. Finally, and it's a broad category, is around fine art. That can include anything from paintings on the wall to archives and rare books to statues and jewelry. It's a very broad category of assets that obviously requires quite a specialised valuation experience to undertake. So Josh obviously showed us the CPI for New Zealand and Fiji earlier, and the cost of construction is definitely not immune from these changes as well. In fact, I think the cost of buildings increasing as much as any other industry, if not more as well. One of the key things we wanted to highlight here, and because we get asked about this on a daily occurrence, how much should we increase our last year's values by? What we wanted to highlight is there's no single broad index that can be applied. Each asset and each industry and each type of building, for example, has specific attributes. These all influence the change in construction costs that need to be accounted for when looking at construction cost changes. We've all, I'm sure a lot of us have been at social events or at work or seeing in the media about costs of construction and hearing 50% plus and a bit of doom and gloom around the cost of construction. And whilst there is no doubt some inputs into the construction process are increasing significantly more. So if you look to the far right around the structural metal products there and the increase we're seeing there, that it's not all of the construction costs are growing at that same rate. So whether your assets are in a certain industry or whether they're comprised or constructed of certain materials, again, has a big influence on the changes in construction costs. So some of the costs of actual construction here we're seeing in the last 12 months, the change in cost varies from 10% to 18%, which when you're talking about significant sums of money or cost, then that's obviously a big variance. So I encourage you to not look at a broad single index, but to speak to a professional around your specific assets and the industry that you operate in and what the costs have been doing in that industry or for your specific assets, because again, there is some significant variance here. So just to touch on briefly what are some of the factors that are driving costs up. A construction project you could very broadly break up into three key areas. So materials make up about 40% of project costs. We just talked about metal products then going up 30% plus in the last 12 months. Obviously, depending on what an asset is constructed of, these are having quite a significant impact on project costs and in turn declared values. Whilst this has been impacted by supply chain over the last 12 and 24 months, it's still occurring, but we are seeing that drop a little bit. However, this is being countered by the fact that a lot of materials to construct or to make, are heavily energy intensive. So as energy prices are increasing, that's keeping those costs of those materials at a fairly high price point. Labour. So this is often the largest component of a contract price and makes up roughly half of a construction cost contract. Again, I'm sure most of us in the industries that we work in have seen significant wage pressures, significant challenges in finding skilled resources over the last 12 months in particular. The construction industry is not immune to that. So I think a recent survey said 9 out of 10 construction companies were saying that they've been looking for more workers and are struggling to find them. So that skill shortage is definitely having an impact and driving costs up in that labour market, particularly when you look at certain large projects that require a lot of subcontractors as well. So they come in for a fairly short period of time and they're able to demand higher costs now. Other inputs into the project is, there's a variety of them, but some of the key ones are around the cost of borrowing money and professional services costs. So if you look at increasing interest rates, that's also pushing up lender scrutiny around development loans as well, which in turn is increasing the cost of borrowing, which, as you can imagine, gets passed on quite often. Professional service firms, again, are seeing an increase in fees and a shortage of labour. So I think I read an article the other day that said there was something like 4,000 job vacancies across the region from the tier 1 accounting firms. So as typical supply and demand, as that happens, it's seeing costs increase as well. Just finally, it's not just buildings, like I spoke about before. If you're procuring a large piece of equipment or machinery from overseas, you're also going to have the impact of the supply disruptions. With the cost of shipping has been increasing significantly over the last 12 months or 24 months. We're seeing that starting to steady off, but it's still at a very high rate. We're also seeing countries that build a lot of these pieces of machinery. They're struggling in terms of demand as well, and they're focusing on supplying to their local market, which is increasing delays in terms of getting those pieces of machinery across to New Zealand and Fiji. Let's on to the next slide, please. So what are some of the common mistakes we see when we're declaring values or clients are coming back to us? I'll go through these quickly, but there's a few key ones that we see often. And one of the key ones is using last year's values or a previous valuation from a few years ago and simply increasing by a percentage, whether it's CPI or another percentage that you've been told. It goes back to my initial point around there's no broad single percentage you can increase values by. Often we see clients looking to declare on their book value or their market value, so off their accounting side of the ledger, not assessing all asset classes. I spoke about that before, only focusing on the buildings or the individual large sites. Looking at what you would prefer to replace the asset with. This is another common one where, and it's reasonable thought process around not wanting to put back the exact same asset, but if you did have a loss, you would reconfigure or build of different materials. Insurance policy isn't necessarily made to respond that way. So it's possible, but it needs to be a lot of consideration and discussion around that. The next few are around relying on advice from internal or external parties that aren't really qualified to provide that. Second last is around not considering regulatory and compliancy costs. This is called an extra cost of reinstatement. As construction codes are changing, you're not expected to retrofit an existing building based on the current codes. But if you were to rebuild today completely after a loss, you'd have to build to today's current building codes. There can often be an increased or varied cost in doing so. Another one that, as we're seeing M&A activity increase, is relying on the other party's values to be accurate or their process to be suitable. We've seen a few clients get caught out in this manner recently as well. Just finally, to touch on a few other key little pieces of information. I spoke about this briefly earlier. There's FENZ requirements around a levy to be paid for fire and emergency services in New Zealand. I spoke about reinstatement value earlier, and that's the cost to put back the asset brand new. The levy that needs to be calculated, that you calculate the value from, is based on an indemnity value. So that takes into account the specific asset, but taking into account depreciation, which is often lower than your reinstatement value. Inflation, even within indemnity values, still has an impact there. So we're seeing insurers increase scrutiny around declared values, and I believe it's not long before we'll start seeing further scrutiny around these values for your fire and emergency levy calculations as well. Just quickly on the last one, the impact of an underinsurance or a margin clause. New Zealand's in a lucky position where a lot of policies don't have a margin or an average or co-insurance clause, as it's otherwise known, where other regions, these can be quite common and they can be quite restrictive. What this means basically is that if you're underinsuring your assets and you have a loss, the amount of the claim will be proportionally reduced by the amount that you underinsured by. So if you were underdeclared by half and you had a claim, it could mean that you only get half of that claim payment. So the most common way of being able to ensure that this clause doesn't form part of your policy is to have a valuation, and it's a specific insurance valuation undertaken, so you can demonstrate to the market you've done the best thing you can around determining declared values. That's it from me today, and I'm happy to take questions at the end or after the session, and I'll pass on to Patrick Hunter now to talk about business interruption.
Thanks, Simon. Tēnā koutou katoa and Nisabula, everyone. Firstly, I'd like to say what a pleasure it is to be here with you today. It's a fantastic turnout, so thanks for joining, everyone. As mentioned earlier, my name is Pat Hunter, and I look after Marsh Advisory for Fiji and New Zealand. Marsh Advisory consists of many functions and departments, including our valuations team, that's Simon, and another team called Claim Solutions, amongst others, which supports our clients with a lot of things, one of which being business interruption, or as we call BI, insurance matters. A large part of what our Claim Solutions team does, however, is the management of claims, unsurprisingly. This is the pointy end of insurance. It's where, the rubber hits the road, so to speak. And it's typically the point an insured will understand if they have transferred risk as intended, or indeed end up disappointed as expectations are not ultimately met. Basically, the topics today address how to get it right, and to ensure you don't wait for a loss to test your position, okay? As mentioned earlier by Josh, whilst I look after advisory, my practice background is in BI, hence I'll be taking you through the next 10 minutes or so on the subject. We're going to reflect on, firstly, what BI is, matters that should be considered when determining the appropriate levels of cover. And then we'll run through how the current environment, as outlined by Josh and now Simon, is impacting BI. Next slide, thanks. So what is BI? It's complicated. I guess the best elevator pitch I've heard regarding BI is that it provides cash flow coverage to meet the loss of profit and to pay continuing and or sometimes additional costs caused by an interruption from an insured event. So a little bit to unpack there. Whilst purchasing BI cover is relatively common, it's a difficult type of insurance to get right. However, the importance of getting it right cannot be overstated. Seldom BI matters are straightforward, with losses often being complex and material to the going concern of an insured. I know from my first-hand experience, not getting the coverage right can prove problematic. Getting it wrong will ultimately either mean an inefficient use of capital, or unfortunately, we've seen when exposures aren't transferred, the impact on a business can, I guess, be challenging in the event of loss. It should be considered the impact following loss often goes far beyond that foreseen. A fire may be extinguished, floodwaters may recede, but the impact on cash flows, as we've seen, can go for considerable periods, sometimes years, unfortunately. Ultimately, the failure to transfer risk as you expect will mean that you actually underwrite the risk yourself, meaning you'll be calling on the balance sheet or other sources of income if you don't get it right. So where do you start with BI? Ultimately, it all starts with ensuring your declared values represent the anticipated earnings of the business over the maximum period of indemnity. Hopefully that's a little more straightforward, but it's really, really important to understand what that means and ultimately what you're insuring. Next slide, thanks. So I thought today I'd just run through some of the more common types of BI cover. We won't be covering everything, but really the three most common types of BI cover that we see, just on the top line here: gross revenue, insurance gross profit, and additional increased costs of workings. The type of cover you select will ultimately determine the basis of settlement in the event of loss. The basis of settlement is it's a defined approach within the policy wording, okay, which will ultimately determine what your settlement is. So that's hopefully rather straightforward. If the option selected is not appropriate, neither will the settlement, right? So with gross revenue, look, the name is on the tin. It's a type of cover that protects you at the top line. Generally, this type of cover is best suited for insureds with a high fixed cost base. So those types of insureds that will find it challenging to realize any savings in the event of loss. The term gross profit is slightly misleading. Oddly, when I entered the insurance industry, I was an auditor in the Big Four environment for quite a long time. And really bizarre to me. My first day of my insurance career, I had to relearn what gross profit was. So yeah, don't be too hard on yourself if you're not sure what insurance gross profit is. So whilst the method for determining gross profit can vary between what we know as the difference, or what we call the difference in additions method, the easiest way to explain it is that it insures you at the EBITDA line, so your earnings before interest, tax, depreciation, and amortization, plus those costs above the EBITDA line retained in the event of loss. It's for this reason, and it's really, really important, that should you be selecting insurance gross profit, you carefully consider the cost structure of your business. And when you do that, making sure you take the perspective of what your cost structure looks like in the event of a partial loss. Okay, that's really important. You must look at it from a partial loss perspective, not a total loss. The additional cost cover, pretty straightforward. It provides coverage for those additional costs incurred to either mitigate the interruption or to help resume normal business operations following a loss. Look, generally this type of cover is seen in those entities that either have a high fixed revenue base, think here of your councils perhaps, or your government agencies, or perhaps those insureds with a suitably diverse supply or production chain, which allows for material mitigation in the event of loss, obviously save for the additional costs which you're insuring. It's important that when you're considering the appropriate cover, you follow strictly the basis of settlement. As I mentioned before, it's a prescribed method for determining your settlement. And do not go off piece, do not make it up. And as we say to a lot of our clients, don't play underwriter. When a claim happens, your loss adjuster will strictly follow the basis of settlement. Next, all declared values are based on a standard 12-month period, okay, adjusted for the period of indemnity. The best way to explain this, I think, is through a really simple example. So let's say you have a 6-month indemnity period. You really need to think of why you have a 6-month indemnity period. It would seem awfully short, but let's say you have a 6-month indemnity period. A 12-month equivalent declaration, though, should be made. Okay, so you need to gross that up for the 12 months. Next, the calculation should be forward-looking. Probably the best way to explain this is, again, through an example. So let's say your insurance period runs from January 23 to December 23. And your period of indemnity is, let's say, 12 months. So let me think about this. Don't want to get it wrong. You should consider, so when you're looking at your calculation period, you should be considering a period from 31 December 23 to 31 December 24. This is because ultimately your insurer provides cover from the date of loss as long as that is within the period of insurance, okay? And then out to the end of the indemnity period. So assume that the loss happens on the last day of your insurance period, and then you walk out your indemnity period. Now, linking all this back into the current environment, looking forward in such a manner is difficult given the uncertainties at hand. You know, the continued impact of COVID, the Russia-Ukraine conflict, to name a few, makes a complicated exercise even more so. Next slide, thanks. So we've got some considerations here. I got to say, this isn't everything that we go through, but these are some of the key ones, I guess, that are in the press at the moment. So look, you know, we accountants typically use the past to help us forecast the future. The issue, however, is the relevance of the past to what we're seeing in the future, and you know, the relevance of the more immediate past. So the COVID time is really what I'm referencing there. For example, how do you manage the volatility caused by COVID, inflation, and other geopolitical matters? Simply, you know, we've seen industries with reference to COVID that have done well, and we've seen some that have really suffered. You know, the impact on airlines and tourism, to name a few, have unfortunately been incredibly hard for some, catastrophic, in fact. Whereas, say, those, you know, like supermarket industry, for example, has done really well. So with one eye looking forward, you know, we can cross everything we have, your fingers, toes, and whatever else. Hopefully the impact of COVID continues to recede, but how will you forecast the next period of performance? Okay, so let's take the tourism industry, for example. How will you determine the future impact of COVID, be that on the local or international market? You know, will it be the same as pre-COVID, or will it be something completely different? We don't know at this time. You know, drilling in a little bit further there, you know, how will, let's say, the Chinese tourism dollar be impacted going forward by their continued lockdowns and the way they're choosing to attack COVID? Moving into volatility, and sticking with the Chinese tourism example, you know, how's that going to be impacted by the geopolitical matters that are impacting the Pacific at the moment? You know, moving on, I guess, you know, how vulnerable are you to wage spike increases? We know this is happening here in New Zealand and Fiji at the moment, and how are you going to adapt to that, and how will your declared values represent that? You know, what is the impact on fuel rate increases? Look, there's a huge amount that goes into this, but ultimately building reliable assumptions and forecasts to manage these elements in particular is difficult. As hard as it may be, we recommend you consider these things when taking a forward-looking stance on your business, and obviously replicating those views and assumptions through your declared value calculation. Stress testing your assumptions is highly, highly recommended. We spend a lot of time with our clients working on this point and building comfort with the assumptions used. Specifically, I guess just on inflation, before I move on to indemnity periods, should your declaration have remained consistent over the past 12 to 24 months, let's say, you really have to ask yourself if this is still relevant or accurate. All things remaining equal, once you allow for COVID and other elements, year on year, you'd expect your declared values to increase, especially during periods of high inflation. And then finally, on the slide is a consideration of indemnity periods. It's often, in my experience, something that insureds underestimate, allowing for things such as, you know, return of market share, commissioning, consents, availability of contractors, supplies. I could talk for a month of Sundays about the things that you need to consider, but all these things should be considered when you're building your indemnity period. I guess most importantly, still on the last slide, but that's okay. Remember, with your indemnity period, you know, as soon as it lapses, any continued losses will be self-insured. Okay, so just some other factors to consider when determining the appropriate PI for your renewal period. This one is pretty straightforward, makes sense, but it's a limited liability. Due to the things we've already spoken about, you know, we always need to consider if your limits are sufficient to reflect the expected results of the business. So again, allowing for that volatility that we've already spoken about. If the assumptions in your determination or your calculations require material revision in the period of insurance, I urge you to act quickly. Don't delay. Don't sit on your hands, and notify your broker as soon as those instances become apparent to you. It's important to constantly remind yourself of this, especially during these times. Next, contingent loss. Look, we know from our wider area event experience, the impact on indirect damage to your operations can be considerable. When considering contingent exposures, think up and downstream of your operations. So your indirect suppliers, your customers, your indirect customers, your utilities, so on and so forth. Really spread a net, and that net needs to go outside your operations, okay? Probably another example just to explain this, to provide a little bit of context. But let's say, sticking with the tourism example, you're a hotel in Denarau, and you've considered how you would be impacted from a cyclone. But have you considered how you'd be impacted by a cyclone if you have not been damaged, but let's say Nandi Airport has been damaged? What would the impact be on your business? In that example, you'd be looking for for a contingent loss claim. Next, deductibles. Seems relatively straightforward and obvious, but are you clear where your cover starts and how it's to be applied? As I said, it seems a little obvious, but ensure you can, actually fund your deductible. I've seen major losses in the past where the deductible structure has come as a surprise to an insured, and the funding of it has proved challenging. Finally, we know inflation and the time value of money, is becoming ever increasingly important, especially with climbing interest rates. And as such, we know we need to get claims paid faster. The best way to ensure this, and a key part of it, is ensuring your declared values are set appropriately. Okay, next slide. Okay, so we're just going to run you through a couple examples. I'm going to take the first one. Naturally, it's on BI. This is a real life example. I'm working on this case at the moment. So this client is in an industry that got absolutely slammed, unfortunately, as a result of COVID. And what they saw and what they I guess came to us about was to say, hey, look, they're not sure how COVID was going to impact them in the coming periods. So earlier this year, we undertook a BI review, which identified considerable uncertainties, of course, due to the reasons that we've already discussed, in their expected future trading results. So the review considered, all these elements, communicated assumptions and constraints, and the determination of the declared values to the market. Unfortunately, subsequent to the BI review being completed and the risk being placed, the client has had a considerable loss. However, and the good news is, even though the current year trading results, thankfully, prior to the fire, were 2-3 times as good as they were in the prior year, because we have articulated the method in which the declared values have been determined and the limits to the market, this loss has happened. The insurers have already confirmed that the declared values are sufficient and there's no issue with them, and we know that the limits are in play. I guess the outcome and what it means is ultimately this insured will have their cash flows and their profit and loss account reinstated when this claim is all wrapped up. Tim, I think over to you now, mate, for this next example.
All right, thanks, Pat. Hi, everyone. My name's Tim. I look after the valuations from a New Zealand specific side of things. I'm based up in Auckland, and just thought I would run you through a case study with a bit of local flavour. pretty recently in the last few months, we did a project for a fairly major New Zealand client most of you would have heard of. They have around 15, well, they do have 15 food processing sites around the country, everywhere from kind of Dargaville down to Invercargill. They hadn't done any insurance valuations since 2017, and that's because they're food processing. There's very significant buildings, but there's also very significant plant and equipment, processing equipment. So they've done no valuations on any of that since 2017. They engaged us. There was some pressure from the insurance market saying it will help with placement. They need to make sure they're updated. Since they'd had those valuations, they'd only been sort of tweaking them up by a couple of % every year. And the other thing with these major businesses, they have major plants that, you know, old machinery gets thrown out, new machinery gets bought, buildings get extended. One plant, in fact, had been shut down. So it was really prudent that they get some valuations to establish their position. We went through all their sites over about a 3-week period, took all the buildings, all the infrastructure, all the equipment, processing equipment, and it showed that what they'd been doing probably was insufficient for the size of their business and for the changes they'd been making. And it showed about a 24% increase across their entire portfolio. Obviously, an entire portfolio is not going to go down in one hit, but each site was kind of between 10 and 50% up, depending on the site. And some of their major sites were up by in the tens of millions, but overall they were up by over 300 million, which, you know, in terms of placement, if they want to get cover, and having those valuations and that information, it's current, it's been done properly, and that really helps them in the insurance market. And the obvious result was also that they were adequately insured. If any of their sites did happen to have a total loss or partial loss, they've got the adequate cover that ensures that they will be covered. And this client, for example, had a total loss in about 2013 of one of their plants. So, you know, they're probably aware about the benefits of having comprehensive cover. I think next slide. That was a bit of a case study. They just want me to go through a couple of considerations about your valuations and what to look for. The method of value, Simon touched on this a little bit earlier, but the method should be an insurance valuation. Very often people present us with book values that they might have done in a financial reporting exercise. By definition, in most cases, book value is less than replacement cost. So if you were using those, you would be very much underinsured. So it's just, if you are getting a valuation, just ask the valuer and say, hey, you might be doing this for something else, but we need an insurance valuation too that's specific for the insurance market. Just make sure that they're providing that for you. And in New Zealand, there's a fairly standard insurance certificate that they need to provide. So that should always be there, and you can provide that to the broker or insurer. That will also have your FENZ amounts on there. It's also worth reviewing the last time you had a valuation. Obviously, we're all reading the same articles in the newspaper that steel's up by 30% and labour shortages. And that means that even if it's been a year or two, it's at least time to have a discussion about, you know, about how to increase them, if you should be getting that professional advice. And if you've had valuations in the last year or two, go back to your valuer and ask, you know, if they can help and take into consideration today's kind of conditions. The other point about speaking to your broker in advance of the renewal, the misconception is often that, I'll wait until a month or two before my renewal to do the valuation. Often it's not too late, but I mean, I always think the best time is about 6 months before. Brokers will like having an insurance valuation when they go to the market a month or two before renewal. So, you know, I mean, any time is good, but, you know, 6 months before renewal is probably a good time to reach out and have a discussion with your broker. And the other one, which, you know, I think Simon might have discussed this a little bit as well, but declared values are, you know, they're today's costs. I always think of it as if you went and got a fixed price contract on a brownfield site today, that's your replacement cost. But you need to consider demolition in a loss. You need to consider that over the whole policy period, the cost of that may go up. Over the time of construction, that may go up. So that's why getting an insurance specific valuation is really important, because they consider those extra add-on costs. And that's me for right now. And I'm happy to answer any questions with New Zealand specific or valuation specific questions in the Q&A. But I'll just jump back over to Pat, and he's going to run you through a couple of BI considerations.
Awesome. Cheers, Tim. Look, with BI, and just really quickly, because we're running short on time here. BI, it can be challenging to get right, even during times of relative stability. And that is why our team is made up of forensic accountants, essentially. So look, if you're going to take anything away from today's call, remember to constantly review your declared values, and particularly the assumptions therein, right? So in particular, should material peaks or troughs be sustained during the period of insurance, and you haven't allowed for them in your declared value and your forecasts, act quickly, notify your broker. Your insurance contract will typically allow for variations, but you must act, okay? If you're wondering how, here on the slide, it sort of outlines it, but there is something called the premium adjustment clause, generally, which allows for simply, it's a true up, I guess, in the event should an adjustment be required. If you're unsure about all this, again, call your broker, perhaps arrange a call with myself or another one of the team, and we can outline a plan to help you resolve the challenges you may be facing. Okay, that's it from me. Josh, I think over to you for Q&A, mate.
That's great. Thanks a lot, Pat, and also thanks a lot to all of the panelists who have contributed so far. Really appreciate your input and your insights. For those of you on the call, please feel free to jump in and use the question and answer functionality in Zoom, and we'll do our best to get to your questions this afternoon, or this morning rather. And if we're not able to, we'll make sure that we send you an email with the response. But we've had a couple of questions come through, so it's probably timely that we just jump straight into these. So if everyone could appear, that would be great. Actually, the first question here is for Simon, and the question is: are there different ways of determining different basis of values? I think that's a really good question.
Thanks, Josh, and thanks for the question. I agree, it's a good question. I did talk quite heavily around reinstatement costs, and that's typically what a policy will respond to and what the requirement would be. But there are differing bases of value you can look at. So whether it's indemnity value, which we spoke about, which is aligned to your FENZ levy, but it is a potential that you could look at insuring on. The other area you can look at in New Zealand, which again is quite unique to New Zealand and not so much as other regions, is around a modern equivalent value. So looking at what you could replace the capacity of an asset, or what you would replace an asset with. I think there are different ways you can look at things. The biggest tip, or the biggest thing I would say around this, is the importance is not just going down that path of declaring that value and not telling anyone. It's about working with your broker, with your valuer, with the insurers, and making sure there's no grey area in terms of how the values are determined, or what basis of value that you're declaring. It's important that that's upfront and clear. So if there is a loss, there's no issues around that.
Awesome. Thanks, Simon. The next question here is probably for Pat. And again, I think this is a good question, and probably something that many of us have fallen foul of before. And the question is: what happens when you use the wrong financial base?
Well, yeah, I guess as I mentioned in my section, it does happen. However, as soon as you are aware of the facts, act quickly, notify your broker, and make the changes that are necessary once you've realised what the issue is. Time is your friend. You must act quickly. The sooner you act, the lesser the issue it will be. The worst thing you can do is, as I said, sit on your hands and a loss happens and you figure out that indeed the cover isn't fit for purpose anymore. So act quickly is the answer to the question.
So be proactive.
Be proactive, exactly.
Get on the front foot. Yeah, good stuff. Thanks, Pat. This is a good question. I'm going to sort of open up now the claims conversation. So this is a good one for Catherine. So Catherine, what happens if I have a loss and I'm underinsured and my values with my values and my BI coverage?
Yeah. Hi, Josh. Thank you.
Very thought.
Look, this is very similar to the territory that Pat's already covered. I mean, basically, if you can establish to an insurer that even though a loss has come in, which is far in excess of the declared BI values and declared asset values, if you can show to the insurer that you've had a proper sort of system of asset valuations and BI reviews over successive years, and if you can explain the declared value model that you've used, then an insurer is much more likely to be able to accept the gap between the declared values and the loss. For example, you could have, the loss could be so significant because of a sudden spike in commodity prices, which the insured couldn't have predicted. So if the insurer can go back and see that the insured has systematically taken care with its values, you're going to be in a much better position. Just want to reiterate also what Pat said about, to act quickly. If that does happen, come and see us.
Great. Thanks a lot, Catherine. This is a good one for placement, I think. So I think, Justin, you're in the breach for this one. So this question says, I'm concerned about my premiums increasing. What's the expectation from the insurance market with regards to the requirements to having a valuation completed?
Yeah, thanks, Josh. Look, insurer requirements certainly have tightened up in the current environment. Once upon a time, having a valuation done once every 3 years was adequate. But ultimately, as in this current environment where we're seeing, quite significant uplift and volatility around underlying values, there is a requirement now, or insurers are pressing harder to make sure that the valuations are carried out on a more regular basis, if not annual, probably biennial, so every 2 years. And then on that year in between, making sure that there is good external professional advice given for, inflationary factors and what amounts should be given uplift. Yes, there is ultimately a cost implication to declaring insured values, but really, the consideration that should be taken to heart is that you don't want to prejudice your ability to make a claim and for that claim to meet your expectations. There's plenty of sort of clauses, etc., under the policies that do have the ability to limit the amount you can claim. In New Zealand, it's a margins clause. In Fiji and further afield, average clauses. So, ultimately you want to make sure that you're getting those values right so that you are not prejudicing your ability to make a valid insurance claim.
Perfect. Thanks, Justin. And just really quickly, we just had another question come through the system here, which is asking whether Marsh can assist with the valuations of machinery as well, which I think is also a really good question. So I'll pass that to Tim.
Hey, thanks, Josh. Yeah, it's a definite yes. The valuations team across the Pacific is about 35 people, and about half of our valuers are sort of specialists in plant machinery, about half in land and buildings and infrastructure. That case study example I gave before, that was split between myself and a colleague, where I did all the buildings and infrastructure and my colleague did all the processing equipment, machinery, plant, boilers, all that kind of stuff. So it's a definite yes, and it makes up about half of our work. So.
Perfect. Thanks, Tim, and special thanks to the panel for joining me this morning, and also thanks to all of the guests who have participated from across New Zealand and also Fiji, and also thanks for the really great questions that have come through. It's very thought provoking. So we're going to wrap the session up there. Again, really appreciate your attendance. And shortly we'll be sending a follow-up email, which is going to contain the contents of the session that we've gone through this morning. And we'll also make sure that if you have posted a question on the system, that we'll get back to you as soon as we can with a written response. Thanks very much, everybody. Kia ora, and have a great day.